What most people don't realize is that our global economy is one of the biggest causes of our environmental and social crisis. It's the economic underpinning itself. Those in the room today, participants of this conference, obviously, I think there is realization of that. Another way to look at it, if you look at the recent IPBES global assessment, so IPBES is the Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services. I had to write it down because there's no way I remember that. But the chair, Sir Robert Watson, said, "We are eroding the very foundations of our economies, livelihoods, food security, health, and quality of life worldwide." I mean, this is what's happening on our watch at this point, and we certainly need to change things around. Now, I used to work in the finance sector, and we used to be able to, essentially be remunerated and judged on very, very short-term metrics. I think, this whole paradigm needs to change. I think, there's probably agreement in the room, and I don't think it's impossible. Nothing's impossible. Obviously, it's not easy. Otherwise, it would have been done. But if we don't do this collectively, it's not going to happen. So we have to kind of fight through the vested interest to get there. So I want to talk a little bit about value, introduce the concept of value, which has been resonating here this week. It's not about short-term profit in the next minute, next hour, or next month. It's about intergenerational value. It's about value for our generation, the next generation, which is sitting in the room, and the generation after that. And it's about sustainably creating that value. And that does not mean not making money, not being profitable, but it means doing it in an intelligent way that actually brings people and planet together. And we don't destroy the value of future generations, for our own value today. That is just simply a transfer of value rather than any value creation, overall. So I think that discussion needs to take place in the financial markets, and we certainly haven't got to where we need to be around that. And I think the other thing, it's not so far-fetched. If you think of pensions, if you think of investment for children, if you think of mortgages, these are long-term investments by nature, but the financial markets and the system basically reward them on a short-term basis. So this certainly needs to change for us to be able to integrate value properly. So nature and finance, how do they link together? I've touched on it. Just to say a couple more things. To me, one of the best analogies I've heard is finance is like the blood circulatory system in a body. So if you imagine the human body, the finance system is the blood circulating within. It's making everything else work, and it has that powerful effect, and an effect across the entire economy, across business lines, and across geographies. And decisions taken in London, in New York, and Singapore are driving environmental destruction in the Cerrado, in Brazil, in the Indonesian rainforest, and in the Arctic, to name a few. So that link really hasn't been made. Traders clicking on a button, looking for short-term price movement increases are leading to environmental destruction halfway across the world. The story needs to be told. So a few things, of course, we studied in school, modern portfolio theory and the capital asset pricing model. I'm sure some of you have studied this. I looked them up a little bit with Shashank's help, and if you look at MPT, which is a modern portfolio theory, this was developed by Markowitz in 1952. We are 2019. Needless to say, there are certainly outdated elements. The world upon which that was developed looking forward looks really different than the world today. So I think, and the CAPM, the capital asset pricing model, was developed only a few years after modern portfolio theory. Clearly now, the issues we face, the world as we see it looking outside now, is not the same world as 1952. And we certainly need to actually rethink the systemic issues around it, which we'll get into a bit more. So what do I mean about systemic issues in finance? We're not going to have time to get into all of it, but financialization is a big one. So this is just money chasing more money. Trying to make short-term return. And if you look over the last 20, 30 years, there's been a massive increase in how much time finance spends in financialization and not financing the real economy. So last night we heard of the immense progress we've made on social and environmental fronts since over the last few decades. there certainly has been progress, but there's certainly we've had 60% decline in wildlife since 1970. That is not an improvement by any measure. The wealth inequality that was just brought up in the last session needs to be talked about again and again, and in every session we're having, because I think it's something like the top 100 people in the world in terms of wealth own as much as the bottom half of the world's population. I mean, come on, you can't say that wealth metrics have improved. It's just not correct. So I think there's some serious systemic issues in the finance system that need addressing, that are impacting nature, climate change, people, and our planet. The second one is benchmarks. So when asset managers, those who are managing our money, get judged, they're not judged on how much money they're making for us. They're judged on how much money they're making for us relative to an artificial construct that human beings have created called a benchmark. Now, let's think about that for a second. If the broad market goes down 5% and someone managing your money is only down 3%, the market will say he or she has done an amazing job. That actually the value destruction that this person has paid heed to is less than what's happened in the market. Now, again, this is a behavior, a system that permeates global capitalism, and it's causing all kinds of different dislocations in the industry, and I think needs to be, again, completely reassessed. And there's no reason why we should shy away from the ability to do that. We created the benchmarks ourselves, so to say that this is a big thing that we cannot change is wrong, because we created it ourselves, so we can recreate something that makes more meaningful sense. I'll leave it there on that slide because I could go on for a while. And I do want to bring up Adriana and James soon, so something we've been thinking about at WWF is a broader charter for change around the global economy. So here are some things that we are thinking about. Now, if you look at the second bullet, for instance, shift away from GDP, gross domestic product, most governments basically just try to increase gross domestic products, which is a tiny slice of the economic activity. Now, you may say, well, that's impossible. How are we going to get governments to shift away from this metric? It's something that permeates the whole industry. Well, in May 2019, New Zealand did it. It's already done. The budget requires all new spending to go towards 5 specific well-being goals. And those are mental health, reducing child poverty, supporting indigenous people, moving to a low-carbon economy, and flourishing in a digital age. They move to a well-being model and allocate the entire national budget around a new well-being methodology. So people say, oh, this is really hard to change, how are we going to do this? Granted, New Zealand is not the US, and it is a relatively small economy, but they're doing it. And again, it takes leadership, it takes courage, and it takes trying things that are actually a lot more inclusive. Climate change, it's been discussed before. We have to limit climate change to less than 1.5 degrees. Even us all coming here and flying here needs to be thought about. That hasn't been, no one's brought that up, but we are contributing ourselves to climate change by even coming to Bretton Woods 75. And that's something that we should think about. And we have to check in on ourselves as well. It's not only what other people need to do, it's what we need to do. And we need to also we're part of the issue. And we only have about a decade to try to get to less than 1.5 degrees. Otherwise, we tip into something new, and that new is scary, and I'd rather not do that. The SDGs, Sustainable Development Goals, to me, it's only been brought up once so far, which is a bit shocking, actually. And to me, it's about leaving no one behind. We need an equality and fairness built into our financial system, which has long been forgotten. So I think there's value around do we want to galvanize around a global charter for change around our economy? So what we're beginning to think about is people talk about impact investment, which is a niche market in a way, but every investment has an impact. Most of them negative, but it's not as if investment is without impact to begin with. So to me, every dollar, pound, euro spent has an impact, and we need to make more of that going to the companies that are solving the world's problems. And the true driver of actual growth, and it needs to be sustainability, and that actually has to be generating returns itself. So I think really the time is now to build a financial system that benefits people and the planet. So I'll have one last slide before I call up my esteemed colleagues, and it's around the power of personal finance and pensions as an example. Did you know that the total GDP per year in the UK is £2.5 trillion, but there is £3.1 trillion in the UK in terms of the pension pot. So this is individuals' money that they're saving for retirement, which has more actual value in strict GDP terms than the annual GDP of the entire country. So I think pension pot globally is about 1/3 of invested assets. We need to be able to capitalize on the power of personal finance because it is huge. And if we are all calling for that money to be invested in a sustainable way, we can basically reorient global capitalism if we do it right. So with that, I'm going to sit down and invite also James and Adriana to join me, and we'll get into a bit of a discussion, and then we'll open it up to your questions.
I'm still thinking about the pants. You know, my mom made them for me. You must have realized at this moment I'm a very tall person and I'm Mexican, so you have to kind of make up your own clothes sometimes.
So Adriana and James, thanks again for joining me up here. And I think the first question, maybe introduce yourselves in the first question and also answer for me, please. One practical example from both of your worlds, both at the GABV and Triodos, that speaks to what I've laid out and that it basically helps to solve some of or all of these issues.
Thank you, James. So I am Adriana Kocornik-Mina. I work and live in the Netherlands, in Amsterdam. It is a pleasure to be here. My organization is the Global Alliance for Banking on Values. Just a very brief background on the alliance is 55 member banks around the world. We have around 50 million clients together, about 197 billion assets under management together, and about 67,000 people working on this. What we believe in as an alliance is that these are all banks that individually think that working in the real economy is the real purpose of banking, and that the purpose is to do so with a vision of a future that we want. And that requires that you think about what is your impact on environmental regeneration, what is it that you're doing towards social empowerment, and how you're contributing to economic prosperity. So the alliance together is about developing the relationships, the trust, the knowledge sharing, to push this model of banking called values-based banking beyond those banks who are currently practicing it, to benefit more people and to inform a transition of the financial system further. So what is my thought about this? It is about, the start point is, what do people need and how are we going to meet those needs in a sustainable, creating value for community and power and empowerment to people. So that is the point of departure, is not what profit we're going to generate, but how we're going to meet this need sustainably with positive impact for the environment and the people.
That's great. James?
Hi, thanks. So I've been with Triodos Bank for 21 years, and I joined as a sort of, I'd sort of had a bit of a transitional crisis when I was in my early 20s, having a maths degree and a whole ton of quite a lot of political thoughts and kind of values I wanted to put into the world. And by total accident, I found a new bank who were trying to change the world in some way, but in an incredibly modest and informal way of saying, look, here's all the things we lend to. We're lending to organic farms, to wind farms, to social enterprises, to charities, to all sorts of groups where there was an entrepreneur in that business who wanted to do something, not primarily for profit, but because they were motivated by what they could bring into the community, that their strengths were aligned to something the community needed. I thought this was quite radical, and I really liked it, and it was a process of exploration. And being a mathematician, I said, so what are the rules? How does this work? And what are the policies? And how is this all laid out? And I went through what possibly might happen at this conference, which is this realization that there's so much of the financial systems, which has been kind of dominated by a lot of mathematicians, which is abstracted. And the central kind of thing that Triodos Bank is grasping with, is researching still today, is how can you invert that abstraction and how can you reconnect people to these stories? Because yes, we can talk about the impact of our organic farms and how much food, we can talk about renewable energy and the kilowatt hours and the homes equivalent and all of those things. But in a way, that misses the fundamental point, which is, what is it we want to bring into the world? What do we value, whether or not the metrics are kind of making sense? So our starting point, whenever we meet a new entrepreneur, is to ask, why are you doing this at quite a deep level? So what is it that you are really wanting to achieve? What we found by starting with that motivation question is it kind of gave a North Star for everything else that followed. It's a very different perspective of managing risks, in fact, because if you know what their fundamental why is, you know what's defining all their relationships with everything else in their ecosystem, with their staff, with their customers, with their suppliers. And so then you can start to investigate that social balance. And that's where a lot of transactions happen in the real economy. And then once you understand those relationships, you can start to understand from that central why through the social balance to, well, what resources in the oikos level, what is the practical kind of side, what resources are you relying upon, and how are these three strands all in balance with one another? Those three elements, that's where the word Triodos comes from. That is the Triodos approach of starting with the motivation, then going through social balance, and then seeing if things are right on the ground. That's a very different story to the banks who I now interact with through UN Principles for Responsible Banking, the mainstream, who are trying to graft some interesting metrics onto the fundamental principle, which is, well, the bank's principal purpose is for profit, and we've got to do these things, and now we've got to check some other risks, and so we've got to bolt on some metrics. We need to have a taxonomy. We need someone else to tell us what is green or what is not green. For those in the session with Nora Bateson earlier, saying about how a lot of the problems in the world were actually introduced as solutions a long time ago. Context is so important. And in a way, the thing which makes Triodos Bank kind of quite an interesting thing to engage with compared to any blockchain technologies or central banks, which all comes from hard barriers, is that this is soft. Banking is fundamentally a social technology. And the human judgments that underpin sort of understanding what is a business, what is it trying to do, what does balance mean here, is fundamentally inseparable from context. So a lot of what we do when we share all of the projects which we lend to, we do that with a means not to kind of give you the metrics so you don't then need to you don't need to go any further, but we give the stories which kind of enhances understanding, which tries to promote a conversation about, okay, so what is it we need? What is it we understand about these contexts? What do we as consumers, as savers, as citizens, how do we participate with banks? What's the conversation? And we want to engage with that. And although we'll talk about our governance structure later, we have loads of conversations with people about, so what happens? What is it we need next? How do we design this? How do we proactively find solutions for things which we need? And that's the entrepreneurial solution that we're trying to bring in, and that is our fundamental impact.
That's great. Thank you both. And I think I will ask one more question, but then I'll actually go to the audience and see if there's any questions. We don't want to save all that only for the end, so do think about that, and then we'll have more questions. So keep it more interactive from the outset of this. So, but while you think about that, my next question is: you're beginning to touch on it, but so how do we shift the big banks and the big investment houses? which we have some of them in the room. So we have Elsa, who may want to chime in from Barclays on that question. But first, James.
So I've been in the core group of UN Principles Responsible Banking. So Triodos Bank is 15 billion euros, which in banking terms is really very small. It's probably a medium-sized bank in Europe. But when you're sitting next to ICBC, who are like $3 trillion, it's really tiny. And yet, there's a really interesting dialogue that we've been having because of these different narratives in terms of everyone's had their own journeys to now. And one of the key design principles which we kind of embedded within the UN Principles of Responsible Banking is, actually we're not going to set a benchmark. Because what happens when you set a benchmark is you just say, just give me the boxes to tick, because then I can abstract it and I can get some people in the back office and they can figure that out for me. I don't need to engage anymore. What we tried to do was try and make sure that what we had was a principle of, let's get people more aware of what their impacts are, so understanding what the context is. Then let's get people being more transparent about what they're doing and saying, we're going to set some public targets on the areas which we think we've got the most impact on, and we're going to engage our stakeholders in understanding that with us. So you can't claim the credit for a few little, over on the side CSR things, or we save a little bit on business travel, but we might be financing some high carbon assets on a large part of our balance sheet. You can't claim the credit for the good stuff if you're not willing to take the responsibility for the bad stuff. But then we also can think that everything's in transition here. They're learning loops. There's complex dynamics inside individuals. They're all, as we heard this morning, prisoners of our own perspectives. So to try and have, rather than a bar, to try and have this ramp so that we have these loops of accountability, that we make things more visible, and that we get more of a conversation going. I'm not a believer to throw out some challenges on new currencies that we wake up and we change the currency and suddenly behaviors are changed. Neither that we have a new rule book for banks and that behaviors in banks or relationships of banks are changed. It's about changing the conversation one step at a time.
Adriana, what do you think on that, please?
So the Global Alliance has approached this exercise three main ways. The first one is we have what we call the principles of values-based banking. Basically, it means that it defines the values-based banking model, and it has focus on the real economy, triple bottom line approach, transparency. These are elements, of course, that you have heard. Client relations are very important because that impacts how stable you are. The long-term horizon as our priority as opposed to short-term return. And you have to have all these embedded in your culture. Those are the principles of values-based banking. The practice of our members is very impactful. The Central Bank of Malaysia worked with us last year to develop a program to support the evolution of the Islamic banking sector towards a greater focus, not just on people, but also on planet. Because Islamic banking has very much aligned principles with what we've just said. They believe that they have a responsibility for stewardship towards future generation, and individual is not more important than society. It is very aligned. But at the same time, the focus has been more on contracts rather than the actual impact. And so we work with them. So how are we going to be supporting it? We're supporting it through this demonstration and this willingness to share. And another way in which we're supporting, we've sponsored research together with Deloitte, the European Investment Bank, and Bloomberg is our data partner, where we examine 100 largest commercial banks in the world. And we try to understand what is the relationship with their performance on sustainable materiality issues according to the SASB, Sustainable Accounting Standard Board, and the financial returns. And it looks like, really, sustainability as an add-on does not provide financial returns. It has to be embedded. And it also, as the members in our alliance, you've heard about Triodos, it has to be part of the culture. It has to be a commitment. It has to be the decision lens through which you go. And the last point is, of course, we are participating in an initiative on carbon accounting, developing a methodology together with Triodos, who actually was a front runner in this effort in the Netherlands, and developing this methodology for global implementation and bringing in banks from all sizes and all mainstream, non-mainstream, and other parts of the region. This is a global effort. And why do we want to encourage them to measure the carbon emissions in their loan investment portfolios? Is because in this way they can learn to manage. And they can eventually use science-based targets to further meet the Paris Agreement target of 1.52 degrees. So how are we going to do this? It's not going to be one day switching forward, but it's about showing that we are really serious about this work and that it is happening and that there are people benefited, and it's a lens and it goes back and forth and they're constantly striving. And that's probably what I would like to say about member banks. You hear Triodos. It is this constant striving to keep honest to their principles, to their mission, that is so important and is so differentiating.
That's great.
Well, I can tell you a little bit of what our member banks do, and it's they use typically a decision tree, which is a very straightforward. In order to figure out what's in the low investments historically, they just follow traditional sort of accounting approaches to kind of taking the top, the sort of ranking, and taking the largest and figuring out. But then they always ask, does this have a positive impact? Is this loan having a positive impact? Does this have a negative impact? And then the next step is, are there mitigating circumstances? So if it's a palm oil plantation, for example, in a developing country, because it's also about context. You cannot expect to say, oh, now you're not going to be financing any palm oil plantation. So you have to figure out how you're going to support the transition, right? Otherwise there's implosion. So there are procedures that some of our member banks take to figure out ways. If the definition is very important, it's not a metric, it is a conceptual set of eyes to look at. If you're going to be financing in a building on affordable housing, that 90% of the units are affordable housing today, and after the financing, 50% only is because the other ones no longer are deed resistant, then you have to make a decision where you're going to go. But it is a constant effort. For larger banks is more challenging. And that means we need to start thinking about how do we incorporate this practice as well as trying to address what is already sitting on the balance sheets. So it is not an easy situation. I recognize we are working with smaller banks and they are growing very fast, part of the size, but there are approaches that also you probably also can share some of the experiences with the UNEP 5 principles.
Yeah, I mean, just quickly, maybe what I say is maybe contradictory, but I just want to resolve something. So the purpose of accounting, to give a true and fair view of something, should be to enhance the understanding of it so you get a better context, not so you put it in a box so you go, I don't need to worry about that anymore. So there's lots of externalities which we need to incorporate and can incorporate. So this carbon accounting that we now have, you go to our annual accounts, you look at our entire balance sheet, it's around 85% coverage, next year it'll be everything. Here's the total emissions, here's the sequestered emissions, here's the avoided emissions. It's like, right, that's an interesting insight. Then you can have a conversation about it. Right, so digging into those emissions, where are the hotspots? What can you do? What does it really mean for buildings to transit? What does that mean? What's the practical implications? What are the learning loops? It's a means to something, and there's limits to it. So when we engage with mental health charities, for example, it's like, you can't flatten everything into a number of value, but you can really experience it through conversation. So that's just a different way of absorbing context. How do we bring people effectively into that true and fair view? And so I think if the lens is how do we bring that people into true and fair view, when are numbers helpful, when are they not helpful, then it gives a different, slightly less of a dichotomy between do we need to make everything true cost or not? And it's that's the balanced answer. I think maybe the context kind of bit to the. I mean, well, let me answer the question first, which is yes, I think the Netherlands has got a lot of things. There's a lot of people. The Dutch Central Bank, Frank Elderson's leadership has done a huge amount. I think a lot of others in the network for greening financial system, which is also a lot of European-based. Bank of England's done lots. Bank of France has done a lot. Sustainalytics, but I also think there's this kind of over-egged hype on financial centres because that's not where the real action is. So So I think it's really important. And in terms of the masses, flows, and the billions, there is something about financial centers and creating green bonds and all of those things which are necessary in volume terms. But here's the rub. Right now, so when I started financing wind turbines for Dale Vincent Ecotricity 20 years ago, I was the only person you could phone for a wind farm loan if it's an independent developer. There was no other bank covering this space. Now it's so commodity, it's like it's LMA loan documentation out of the box, clunk, clunk, it's just flow through. There isn't really a financial market failure for mature sustainability solutions. What there is a dearth of, well, there's a plethora of really amazing ideas which might address some of the SDGs on things like life below water, life on land, and finance has not got the right levels of engagement with those entrepreneurs right now to get those business models on the ground, to get the things working up, to bridge the paradigms, because we're going to need to find ways to fit this into the financial system somehow with the people we've got, with the tools that we've got, without necessarily reforming absolutely everything as a precursor. And those centers don't happen anywhere near financial institutions in big cities. They happen in fields, they happen in labs, in little impact hubs. They happen in quite funky corners. And it's about maybe how, alongside the stuff which absolutely has to happen in financial, the big financial centers, how do we get a distributed network to be able to filter that learning up? Because if we don't get those new business models created and we're just repackaging stuff into green bonds, we are not going to be able to make the difference we need in the next decade, because those financial solutions are not going to be created in time.
Maybe I'll just make a comment there. I think it's a very good question. Finance moves, obviously. So in my head, because it moves so fast and it moves towards opportunities are, and global capital moves at pace, perhaps a different question is how to influence the whole global system. The other thing to say is, many people will say Europe is the leading financial in terms of sustainable finance. Maybe that's true, but what's really hard to find out is that there's so much quasi-greenwash out there. There's a lot of asset managers, for instance, on that side that claim to be, leading the charge. And when you actually look under the hood, it's not much more than greenwash. So it is really difficult to actually, and for me, it hit me when I was trying to find a junior ISA product for Nico, an investment product for him. And the rating systems, the equity fund level rating system for sustainability on those products are in a way, to put it extremely, misleading. Because they roll up ESG scores, call it sustainability, roll it out the door, and most people will just buy it hook, line, and sinker. Morningstar is such a trusted name, and their equity fund level rating, people will assume a sustainability score is a sustainability score. But I have had issues with their methodology, and now we're beginning to work on that. So it's a very good question because it's very hard to answer. And if we don't shift the US and China on finance and on sustainable finance, it doesn't matter what happens in Europe. So.
Yes, so I can now say, because that is some of we have also a research done on comparing values-based bank with globally systemically important banks, and that research has been published since 2012. But it does need a little bit of work, because you can argue that we are comparing apples and pears, and we were only relying on publicly available information. But since we have launched this joint sponsored research, looking at the commercial banks, there is an argument for them to really pursue. In fact, when you look at that relationship with sustainable materiality issues and their financial returns, the results are positive. And it also means that good performance in material sustainability issues does not necessarily mean that you have as high financial returns. So there is an argument that speaks to their interest. And from a values-based banking perspective, that is not what we want to be speaking. Our currency is not profit and returns. However, we do recognize we need to be able to communicate in those terms because it matters for investors. And this is about leadership, and it's about commitment. And it's also shown that it doesn't matter how much you've increased in your focus on ESG factors, material speaking. It is how long ago you've been doing it that actually has a greater impact on your financial returns. So these are the kinds of arguments that we believe we can share with banks to communicate, while emphasizing that the ultimate purpose of banking is not to generate these kind of returns, but actually to generate and finance the future that we want and our communities and in an environmentally sound manner. So I would say we are heading in that direction, and that this report will be released in September. And I think it will be a very important opportunity to converse around that with many.
So just shortly to build on it, I mean, I think that there is, I mean, and GABV is kind of leading this kind of work, and I think it's interesting in terms of starting the conversation. There will always be evidence the other way, but also there's a deeper question of, is that the right basis of the argument? Is that the basis of the argument we want to win? Because if it's only ever justified on the business case alone, aren't we in some ways missing the point? Are we in some ways kind of rebooting the same kind of algorithm and in a way creating the same possibilities for blind spots? Where you're seeing action kind of now is on the most clear and present risks. So if you're an Indian bank right now, where the solar price has basically undercut not just the price where it's cheaper to build new solar than to build new coal, it's actually cheaper to build new solar than to run existing coal. So the coal plants, about 45 billion of it is stranded asset. It's basically lying on extend and pretend within the balance sheets of Indian banks. The government doesn't know how to resolve it. It's like, right, they've got a different perspective now in terms of the business case, because they're at the sharp end, and they're asked, the board is being asked very different questions. When it feels a little bit further away, and this is the long-term, short-term issue, then it feels ignorable. The business case, if you like, we're discounting those issues which are of central importance, and that's where we need to win a different argument. That's where we need to think more generally about value creation versus value extraction, and what's the role of banks within society. And they do play, last point, they play a different role, and maybe they can't compete in the way that they're expected to on capital markets, because people say, they won't invest in banks, they'll just go to something else. Yeah, okay, so what's the role we need banks to play, and how do governments resquare how banks look in the capital markets? That's another issue.
I could start, I guess, on the latter point. It's a good question. I mean, before, I think it used to be reputation, regulation, risk. This drives finance sector decision-making. And if you make arguments in those veins, it does get listened to and sometimes acted upon. I think things are changing fast. Now you've got, for the large global banks, you have their customers and their employees actually clocking on to the environmental and climate agenda. So if they want to hire the best people, they're going to have to show, not only talk about, but show how they're driving change. Otherwise, people don't. Those people don't want to join that institution. That's business. That's their workforce. And without most businesses, financial institutions, human capital is your biggest asset. If you're not positioning for that, they're going to go somewhere else. So I think that's a real change that's happening fast now, and we can capitalize on that as WWF. I mean, to me, if we don't shift finance and essentially the global economic system, we're going to be fighting conservation fire after conservation fire. And that's why we are now doing work on these systemic issues. I mean, we have been, but we're kind of trying to scale up a bit because we want to attack these issues at the root, at a root cause. And it's about systems design change, and it is about the global economic system, which is big and scary and so forth. But it is a system. There are rules, and these rules can be changed. I mean, the GABV and Triodos are examples of playing a completely different paradigm and being successful. Yeah, it's not all the mainstream banks and high street banks in the US and UK, but it's certainly a really good start and a base to build from. I mean, I in terms of your other question, I have names in the UK that I'm more familiar with now, having spent some time there and working at WWF in the UK. The US market, I'm not as comfortable kind of naming, maybe benchmarks to start from, but we can talk offline on that.
Yeah, I mean, in terms of impacts and benchmarks, and again, it's quite hard to sort of advertise others, but I mean, if you take, I mean, there's people like Root Capital, there's Acumen, there's Triodos, there's a lot of people in the world doing stuff, but in a way, again, to challenge, the opportunity that impact investment gives is that it's reconnecting people. People are being able to see huge amounts more transparently about what is it my money's doing and how does this work. People are wanting to tell the stories that brings you in. Contexts are also dynamic, so they're changing. So in terms of, well, a benchmark, well, if you care about volumes of low carbon technologies being deployed, there are tons of infrastructure funds in renewable technologies, and then that's your benchmark. If you're thinking about, addressing emerging market inequality, access to finance, intersectional kind of businesses which include different health and education benefits, then there's different things there. And in a way, it's engaging people to take more decisions. Crowdfunding is a next kind of form of it. And I think that diversity allows for more practices and then less relevance to a benchmark per se. Yeah.
So I would like to just get started a little bit. I actually used to work on adaptation to climate change at the London School of Economics before I moved to the Netherlands. And so when I think about separating environmental and climate change from social issues, I recognize that is probably not the best approach. And for our member banks, we have developed a scorecard that helps us understand where they are in their practice of values-based banking according to the principles. But it also helps us to communicate with them why climate change, and we have also the latest in Laudato Si by Pope Francis, right? Climate change is eminently a social issue. And we need to maintain it connected, because otherwise we do not address it simultaneously. So we do find some of our member banks in Latin America very concerned with poverty alleviation, not thinking always about perhaps the need to provide means for adaptation. So maybe seeds that are slightly modified for drought resistant, or flood defenses or something like that. But the conversation helps them to start thinking about the kinds of products and services they need to be developing. Nepal is one of the banks that we have in our network that works very strongly on environmental issues, connected with the need to have solar panels in areas where there's not a lot of energy sources. And we have Bangladesh that has developed all sorts of products to address the question of, well, also elements of flooding. And so I recognize your concern, and I do see that at some point your attention has to be following, but I don't see that we can link, and the Sustainable Development Goals has them all connected, as well as interdependent, which is one of the arguments that we were hearing during this, with the one, I forgot her name right now, but so Nora. So yeah, but I let. I'm always happy for this conversation. It's definitely something for us to be thinking about.
So I love this question because it goes to the heart of what is banking then? And is it enough to just be, well, we do that, we bring the money and that's all good and we can tick some boxes and not others. In fact, so when I joined Triodos Bank, I'd heard of renewable energy and I knew about sort of social justice. I then heard about some of these quirky organizations we were working with, like the Soil Association. It's like, there's an association for soil? Really? What's that about? I was able, though, to tap into my motivations, my values, and then learn about other things. So there was a cross-fertilization going on. So I was joining a community and able to learn from other things within that community. And in a way, that's what banks are actually doing when they're bringing the money. They're actually, we started, the forerunner to Triodos Bank, the joke was it was a bank with no money. Because we'd go to a community and we'd try and understand the risk. And we'd say, we've approved the loan. All we've got to do now is help you raise some deposits so we can fund it. And that's the social role that we're playing by thinking about how do we make the connections between different parts of society? What's the actual role that we're playing? And then that connection role, what we've been doing, is cross-fertilizing within our customers. So you take a building like this, or heritage properties, for example, cultural buildings, a lot of them, especially in Europe, where they're a bit more precious about things because they tend to be older, they say, well, you can't possibly touch the fabric of this building. It's been this way since, the 1600s. And you say, oh, well, have you thought about ecological things? It's like, we're a cultural trust and this is what we do. Fine. Well, have you noticed that up the road, there's this other building and they've gone through this process where they've transformed from like a G to an A+ label, and they went through quite a few challenges, but maybe you might want to meet them and understand their experience. Oh, so then you open up a pathway which is helping to cross-fertilize sustainability. It's also very effective business development. And through that, we're getting health and social care practitioners getting really interested in organic food. We're getting renewable energy developers thinking about deeper community engagement. We're thinking about how all of these things connect, especially so green tourism. I mean, it's about, in a way, it's interfacing with people and what they need and understand. All of that cross-fertilization goes in. So if you've got a genuine motivation from the entrepreneur, which is what I kind of started with, there's an entry point to have those conversations. So even if it isn't perfect, so when there are potentially conflicts, there's something you've got to work with which can improve the situation, and that's our continuous process of improvement. So very shortly on this, because I do a lot of work in advocacy and on this, and I find the funding gap frame entirely unhelpful, because for sure there's a transition, but given that, so my opening sort of contention that there is not really a funding gap for mature renewable energy technologies, the mature kind of low carbon technologies, the problem isn't about those sustainabilities and more volumes going there. It's about what do we do to resolve this other stuff. So European Union has put a lot of work into a taxonomy to define sustainable. Really, if you want us to be able to kind of move things on, it's got to be able to figure out what to do with the unsustainable stuff, because that's where the problem is. And it's a shared problem right now. Banks do not have the capital to write off the high carbon assets, which governments need to get off their books. But Andrew Neil was making all these gun analogies. It's like, that's a gun which points both ways. Governments really took the action that's really required right now in terms of the transition. Most of the banks in any jurisdiction would fall over. There are not the bad banks to soak it up. What's the plan? And so that's the trap that they're held with, and that's not a funding gap thing. So the question is then, what is the real resolution mechanism that's required to resolve away the unsustainable stuff that's on the balance sheets right now? We don't know how to get rid of it.
But isn't that creating a new bad bank?
Yeah, could be. It could be. And then the question is, how do you incentivize that? So if you thought that there's going to be a bad bank coming, and then you're a bank and you're thinking, well, that's going to take a few years to get away. Why don't I just do whatever? Why don't I make hay while the sun shines? Because someone's going to make that problem disappear. You probably end up with an incentive to do all the wrong behaviors in the meantime. So this is how the behavioral psychology overlays to this. How do you do it? It's true, if there was a bad bank today, and in Bretton Woods 75 we just made one, and we said, right, we're just going to take all of those assets off, that'd be a good thing. The reality is, it's like those mechanisms, they take quite a long time to come through and people react to it. So I think it's all about creating those mechanisms, and we're advocating some policy mechanisms, we're designing things, really happy to have conversations about what good ideas would be, but I think it does require mechanisms for how is this stuff going to be resolved, because it's going to be socialized in one way or another.
I think the other thing maybe to add there is, perhaps we put too many eggs in the disclosure basket, and I've been thinking about this recently. So you get a lot of disclosure. Someone has to analyze it. It has to be correct. Then you have to galvanize action around. This takes a lot of time. The other way to do it is, for instance, you could do like a brown penalizing factor, right, on brown loans. So you actually have to, as a bank, you have to hold more reserves against brown finance than the green or blue. It's not just green; it's blue for us as well, ocean. And you could have a positive factor for green and blue investment, which the EU taxonomy did not do. Right? They decided to avoid the big 90% of the market, the brown side, and focus on the small green side. So that's its taxonomy is good, but that's one shortcoming. So I think there are things we could do. Now, those that get into politics, but they can galvanize action much faster. And I think countries like China are considering those approaches. So I think that's the way we need to go. And we need to shift big capital. I mean, we recently now are doing work on sovereign debt. So forget the size of green bonds. Sovereign debt is 60% of the outstanding bond market. It's 60 trillion, I think, from what I remember. And how can it better integrate environmental risk and ultimately hold governments to account on how they manage environmental assets? To me, that's interesting because it's a market that, if we try to shift a bit, can make a massive impact. So I'm much more interested in shifting the sovereign bond market a little bit than I am in really greening the green niche of the green bond market.
I fully agree with that. And I think that's also big differentiation between investors and banks, because investors in the divest movement, it's like you can just hit sell. Banks are kind of in. So you've got, in fact, there's much more potential for that kind of agency, especially when it's with, say, the utility companies. So, and there's banks who are doing that. So in the UN principles right now, there's banks who are kind of starting to have that engagement process. I think then the relevant kind of things is, what's the time scale? What is really feasible? How does, what's the other kind of arms of government doing to those companies, and how does that flow through back to banks? But I absolutely agree.
I just wanted to add, we have some examples of member banks who actually work, for example, with their municipal governments to guide them through what sort of criteria they need to put in place if they want to select another bank to work with. So in some ways, it's indirectly working through other actors in society to start putting pressure also on those banks with balance sheets that are unsustainable. So they create the pathway you're talking about, but it's not just a regulator doing that, it's also the client. And then lastly, we shouldn't forget there are actually the customers, right, at the end of it. And that demand side for sustainability is very important. I know there's a number of research projects going on right now. What would it take to shift clients from mainstream banks towards more sustainable banks? And they're trying to understand why is it that people have one bank account and they just simply never change, right? There's a little bit of that. So I think the efforts are coming from all sorts of top-down and bottom-up and sideways that we need to be thinking about. And us as a global organization, we try to bring all these perspectives to bear towards a finance system that advances the future that we want for Nico and for our children and future generations. So just from a Global Alliance perspective, we are going through the development of its new 2020-2023 strategic plan. And one of the conversations we're having is our European member banks some of them tend to be very present in the European Commission, the Parliament. And the question is that something that as an alliance we can support, either through research or some of the arguments that we are developing? But there's also the opportunity. In February, we were in in Vancouver, and we had a conference called Migrants, Me Too, and Melting Ice Caps, redefining the banking system, the financial sector for a radically different future. And what that brought together actors from all sorts of sectors in society. And the idea there was about partnerships. So I don't think that we are thinking about directly going to voters and explaining to them, look, there's these trustful banks, right? It's more about partnerships, because actors like CARE, or even an organization in Los Angeles that works with the mayor that is trying to address Mexicans who have no legal identity, so they are unbanked, or migrants and refugees in general. Those are the experts on those groups. And so for us, as banks, as members of the Global Alliance, it's not about completely redefining the wheel, it's really working with those actors who know. So one of our member banks, ABS, is working with Oiko Credit to develop a product that's going to allow them to finance development beyond Switzerland, right? It is that kind of, and I go back to this idea. So I hear your point. I think partnerships are very important, and it's something that we as a network association of practitioners think very carefully about, and we really want to advance that as the social fabric of our societies.
Yeah, well, I may start, which is there's a cycle. I think the cycle starts fundamentally by getting out more. So seriously, I was at Cambridge. A lot of people did maths, went straight into banking. a lot of people sort of thought, oh, it's this crazy hippie bank you work for. It's like 20 people in Bristol. About 10 years later, they were saying, oh, yeah, about, the financial crisis time, they were all kind of like interested in jobs. And what was interesting is, and they were super brilliant people, but they'd never really met a client. They'd never been to a farm. They'd never experienced business. They never had to understand context. They'd had a very sort of precision tool for one little element, and so they weren't able to understand that wider context. And if you live in that context, it's much more easy to have that reflective conversation. From a leadership perspective, it becomes easier to people can lead from that dimension. And I think that what it also is, it's like if banking is going to be about human judgment, and just to also say, because all the sort of technology, blockchain, all this kind of element of abstraction, algorithms and AI, even predictive AI, is based upon the past. The crisis we've got is we're not being able to crystallize the solutions in the emerging future. And you can only do that if you're skilled in being able to understand and sort of make sense of all of these blurry, fuzzy connections in this emerging future, which means getting out more. And I think that's been at the heart of the ingredient that's kind of kept us fresh. If you then crystallize it and say, just tell us the formula, just tell us the policies, and then we can just photocopy and replicate Triodos, and we'll take it to India tomorrow. Totally misses the point. It's about being able to give a culture of people. It's like getting people, and this is across the alliance, people who understand that context, who are curious and caring about like what's the role they could play in that community and be useful.
So from our side, we have the scorecard, as I was mentioning, and what that does, it tells us a couple of quantitative factors. So we look at real economy, the total assets. We know how much triple bottom line is a part of the portfolio. We look at low quality assets, return on equity, all sorts of other indicators. And then we look at the qualitative elements. And these are leadership, organizational structure, because we want to make sure that the mission is protected, the types of products and services that member banks are offering. We are looking also at human resources, because we believe that human resources are in itself a core component of the bank. And then we look also at management systems more broadly. So if you're looking at risk management systems, then you're not just saying, okay, well, risk, return. You are actually funding in the question of purpose, bringing it into that decision-making process. And lastly, reporting transparency. So what does that do? It actually enables the bank to constantly be reflecting and recognizing leadership is critical, but if you don't have that going into all sorts of levels within the organization, you just can't sustain the initiative and the innovation, because these are very innovative banks. And so we have also something, there's a MOOC called Just Banking. It is offered by MIT. We have a leadership academy as well that is offered by the Presencing Institute in MIT. We have other kinds of community of practices that bring together member banks from different parts of the world. And all of this helps to keep everybody learning from each other, because that is ultimately the purpose of the Global Alliance, to enable the knowledge sharing and also to support that daringness that these banks already are demonstrating, because they are operating in very challenging circumstances very often. So I think your question is true. I would just invite you to consider that there is a true human motivation to do good. And even if it's from a basic perspective of saying, I want to avoid harm, to how am I going to actively do something good, and how am I going to advance particular objectives, then that actually comes back in, and it's moving away from a profit maximization logic, and it's really focusing on other aspects. And it does work, because we have member banks, and they've been here, and they actually, when you look at them over the period post-financial crisis, they have a lower volatility than the global systemic important banks. Why? Very good reasons. They're grounded in the real economy, they know their clients, they have been looking carefully at their decision, at their loan allocation decisions. It's a very different model. So there's also the aspect of viability and impact that come together.
been very good questions, and then we will close here. I think I'd like to thank James and Adriana for joining, and for all of you and the great questions.